Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alumis Inc. Annual Report. Alumis Inc., a clinical-stage biopharmaceutical company, specializes in developing medicines for autoimmune disorders. The company's portfolio includes several promising treatments that have shown potential in addressing various conditions. At the forefront of Alumis offerings are invutusitinib and Alumis 5, both of which target tyrosine kinase 2, TI-KATWO, to treat plaque psoriasis and systemic lupus erythematosus. Invutusitinib is a TI-KATWO inhibitor that has already shown efficacy in clinical trials, while Alumis 5 is an allosteric TI-KATWO inhibitor that is currently in Phase 1 for the treatment of neuroinflammatory and neurodegenerative diseases. In addition to these treatments, Alumis Inc. is also developing lonigutamab, a monoclonal antibody targeting IGF-1R for the treatment of thyroid eye diseases. Furthermore, the company is working on interferon regulatory factor 5, IRF5, to address immune dysfunction. Overall, Alumis Inc.'s diverse portfolio of treatments holds great promise in addressing various autoimmune disorders and neurodegenerative conditions. Alumis Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Alumis Inc. trades at a higher price-to-book ratio of 8.71 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 24% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for companies in the pharmaceutical industry are multifaceted. Successful development, approval, and commercialization of product candidates are crucial factors that contribute to revenue growth. Regulatory approvals for one or more product candidates also play a significant role in driving revenue. Collaboration agreements with partners are another key driver of revenue growth. These agreements can generate substantial revenue through upfront payments, reimbursement for research services, milestone payments, profit-sharing arrangements, and royalty payments on commercial sales. License revenue is also an essential component of revenue growth, including non-refundable upfront payments, reimbursement for research services, and milestone payments. Milestone payments from collaborators are a significant driver of revenue growth, with regulatory milestones payments reaching up to $36 million and commercial milestones payments reaching up to Yen 15.5 billion. Royalties on worldwide net sales also contribute significantly to revenue growth, ranging from high single-digit to low-teen percentages. Tax credits and net operating losses, NOLs, carry-forwards can impact revenue growth or decline, but their effect is more nuanced compared to the other drivers mentioned. Overall, a combination of successful product development, collaboration agreements, license revenue, milestone payments, and royalty payments are essential for driving revenue growth in the pharmaceutical industry. The net income of the company experienced a decline from 2024 to 2025, with a decrease of $50.9 million. Furthermore, the loss in net income was also reduced during this period, decreasing from $294.2 million in 2024 to $243.3 million in 2025. This indicates that while the company's financial situation is still unfavorable, it has shown some improvement. The profit margins of the company were negatively impacted by various factors. The lack of revenue in certain years made it difficult to calculate profit margins accurately. However, it was noted that reduced U.S. drug prices, increased operational costs, and regulatory changes all contributed to the decline in profit margins. These challenges have likely had a significant impact on the company's financial performance. The financial health of a company can be gauged by its ability to generate positive operating cash flow. However, in this case, the data suggests otherwise. The net cash used in operating activities for both 2025 and 2024 indicates that the company is utilizing more funds than it generates from its operations. This trend is further confirmed on page 132, where it explicitly states that the company is generating negative operating cash flow. The figures provided on page 109, which show a net cash used in operating activities of minus $369,523,000 for 2025 and minus $255,078,000 for 2024, reinforce this conclusion. In essence, the data paints a picture of a company that is struggling to generate sufficient cash from its operations. This can be a cause for concern, as it may indicate underlying issues with the company's business model or financial management. The performance of various regions in the market was a mixed bag. On the negative side, the European Union, EU, United Kingdom, UK, and Japan struggled due to regulatory challenges that hindered their growth. The EU faced additional difficulties with reduced protection of intellectual property rights. In contrast, the US managed to perform well despite being affected by trade disputes and tariffs. This resilience in the face of adversity is a testament to the country's economic strength and adaptability. The management is expressing caution about the company's outlook due to substantial losses expected for the foreseeable future. The transition to profitability depends on successful development and commercialization of product candidates, which is uncertain. Despite this, the company is optimistic about its prospects, citing the potential for revenue from collaboration agreements and the expertise of its directors in the pharmaceutical industry. The management acknowledges that there are numerous risks and uncertainties associated with biopharmaceutical product development, including regulatory approvals. However, they believe that their risk management process will help mitigate these risks. The company is also focused on retaining top talent through executive compensation packages that align executives' interests with those of stockholders. Overall, the management strategy appears to be centered around managing risks and uncertainties, while leveraging its expertise in the pharmaceutical industry to drive growth and profitability. The company's approach to shareholder returns is notable for its focus on share repurchases rather than dividend payments. Through the use of stock options and restricted stock units, RSUs, the company has been able to buy back shares from employees, directors, and non-employee consultants. This strategy allows the company to retain ownership and control, while also providing a means for key stakeholders to benefit financially. Supply chain disruptions loom large. The current business landscape is fraught with potential disruptions to existing supply chains. One major concern is the impact of tariffs on global trade, which could lead to a breakdown in the smooth flow of goods and services. Furthermore, vulnerabilities in third-party service providers have raised concerns about cyber attacks and disruptions that could cripple entire supply chains. Regulatory requirements and trade restrictions also pose significant risks to supply chain stability. The loss of key suppliers or manufacturers due to unforeseen circumstances, such as regulatory noncompliance or quality control issues, could have far-reaching consequences for businesses. Additionally, delays in submitting regulatory applications due to supply chain issues with third-party manufacturers are a pressing concern. These potential disruptions underscore the need for companies to be proactive and vigilant in managing their supply chains. By anticipating and mitigating these risks, businesses can minimize the impact of any disruptions and ensure continuity of operations. That concludes the financial summary for Alumis Inc. Feel free to comment below, and I will be happy to answer them when possible.